Did you know that 90% of investors lose money in the markets? Shocking, right? But the worst part is, most people don't even know they're falling into traps that lead to these losses. But today, that's going to change. I'm going to walk you through the 7 worst investing mistakes that cause people to lose money and then show you what the pros do differently so that you can avoid these mistakes and build real wealth. If you're watching this, you're probably already thinking about building your wealth, right? Maybe you've dipped your toes into investing, or you're just starting out. Either way, you're in the right place. I'm going to break down the mistakes that 90% of investors make and help you avoid them. Mistake number 1. You don't invest your money. Let's start with the big one. You're not investing your money. Now, a lot of people in America are stuck in one of 2 categories. Either they're spending every dime they make, or they're saving it all. Let's talk about the first one. Spending everything. Studies say that 55 to 75% of Americans live paycheck to paycheck. That's crazy. Basically, most people make money, pay rent, buy groceries, and have nothing left. So where's the room for investments, vacations, or savings? And here's a funny thought. Over 70% of Americans have a Netflix subscription. Not to single out Netflix, but think about this. Most Americans are spending more on Netflix and they are on investments. Imagine if that were the other way around. You should be investing more than you're spending on entertainment. Prioritizing Netflix over your future just isn't the smartest move. Look, I get it. Work is stressful, and we all want to relax and unwind. But without investments or savings, how can you sleep soundly knowing that your family is depending on you but you have no backup if something goes wrong? Mistake number 2. Saving all of your money. Now, let's look at the other side. Saving all of your money. I grew up in a traditional Indian household, where saving was the golden rule. The mentality is, save everything, spend nothing. The problem? Inflation. Let's say your savings account is earning 0.5% interest, but inflation is 3%. Your money is actually losing 2.5% of its value every year. For example, if you have $100 in your savings, you just lost $2.50 in buying power. If you've got $1 million, that's a $25,000 loss, just by leaving it in the bank. Don't get me wrong, saving is important, but saving alone won't make you rich. To build real wealth, you need to invest your money. Otherwise, you're just letting inflation eat away at your wealth. Mistake number 3. The casino effect. Next, let's talk about the casino effect. A lot of investors are treating the stock market like a casino, and I get it. It's exciting. With apps like Robinhood turning investing into a game, it can feel like a quick way to make money. But here's the problem. Investing is not about flipping. It's about slow, compounded growth. Warren Buffett, the most successful investor ever, averages a return of 19% a year. That's not 100% returns like Bitcoin, but it's enough to build massive wealth over time. And here's the kicker. Bitcoin and other high-risk investments can make a lot of money, but they can also lose you money just as fast. So, understand the risk and don't treat investing like gambling. Mistake number 4. Missing big market moves. Here's another big mistake. Missing the big market moves. Warren Buffett has said, time in the market beats timing the market. And it's so true. You can't predict when the next market crash will happen or when the next big boom will come. You just can't. Instead of trying to time the market, focus on long-term growth. Keep buying into the market, whether it's up, down, or sideways. Just keep adding. Bank of America has shown that over 90 years, the market grew by an astonishing 17,000%. But if you missed the 10 best days of the market over those decades, your return would have been just 28%. That's why, if you just let your money sit, it will compound and grow. Mistake number 5. Investing based on emotion. Next, let's talk about investing based on emotions. Markets go up and they go down. We've seen it time and time again. People panic, sell everything, and lose out on massive opportunities. We saw it in 2022, when the stock market dropped by 20%, and in 2008, when it fell by 57%. Emotions will always lead you to panic. That's why I like to call it poop. Panic leads to overselling, which leads to opportunity and profits for long-term investors. The key is to stay calm. Don't sell during a downturn, and take advantage of these market drops to buy at discounted prices. Recessions and market crashes create more millionaires than any other time because they give savvy investors a chance to buy solid investments at discounted prices. Mistake number 6. Short-term thinking. Another mistake is short-term thinking. Everyone wants to flip stocks or trade on the short term, but the truth is, the key to investing is owning good investments for the long haul. When you buy great companies, let them grow over the years, not weeks or months. And guess what? When you hold investments for longer than a year, you get tax benefits. You qualify for long-term capital gains rates, meaning you'll pay lower taxes. So, instead of flipping, focus on holding for the long term. Mistake number 7. Ignoring fees. One of the biggest hidden traps is ignoring fees. Whether it's a 401k, mutual fund, or financial advisor, there are fees eating into your returns. Let's say you invest $1,000 per month and get an 11% return. If your advisor takes a 1.5% fee, you'll lose about $600,000 in fees over your investing career. That's a huge chunk of your potential gains. That if you go for low-cost ETFs or index funds, your fees can be significantly lower. Even a small fee difference can mean a huge difference in the amount of money you make. So, always understand the fees and make sure you're not losing more than you should. How to win and avoid these mistakes. So, how do you win at investing? It all comes down to knowing your strategy. Hands-off investors should find a good financial advisor who aligns with their goals. Passive investors should focus on buying and holding good funds regularly. Active investors need to stay informed, study market trends, and be prepared to seize opportunities when they arise. No matter which strategy you choose, make sure you're committed to long-term investing. Stick to your plan, avoid panic, and let your investments grow over time. We've covered the 7 big mistakes that cause most people to lose money, but with the right strategy, you can be on the winning side. If you enjoyed this video, share it with a friend, family member, or anyone you know who's looking to start investing. And don't forget to subscribe to get more tips on building real wealth. Want to learn more? I put together a free investing masterclass where I'll teach you how to find investment opportunities before they hit the mainstream. The link is in the description below. Thanks for watching, and remember, build your wealth, one smart decision at a time.